Give it a little bit of time here. As people are hopping in. Well, Josh, I think it's a good time. I think we've got people hopping in right now. We want to respect everyone's time for lunch. I hope everyone had a wonderful rainy, soaking Tuesday, and we're all enjoying the sun now. I'm Tim Royster here with the Royster Hearth Group Compass, and I'm really excited to have Josh Golding from 4J Wealth Management with us today. We have a slew of ideas and topics, and to give you a little story for everyone. Over tacos back in December, I was talking to Josh, and we started learning more about their business and our business, and we just started seeing that there's a connect here, a way of understanding, how we help our clients at a high level as far as financial discussions, and also for me, for real estate, and making sure that we're making wise choices in our purchases and our sales. And I hear the same thing from Josh and his team over at 4J Wealth. So, Josh, it's all yours. We can't wait to hear from you. We're gonna have a lot of questions, I'm sure, but can't wait to hear what you have to say today. Help us understand our own financial well-being, what to do in 2024 and beyond. So it's all yours.
Great. Thank you so much, Tim. And it's a pleasure to be here. And I just want to thank you for the opportunity. I think what Tim provides to you as clients is very similar to us. It's very forward thinking, really trying to be full service and do everything they can to give their clients the knowledge and information they need to succeed, whether it's in real estate or broader financial areas. So what we typically do for these webinars is we allot about 45 minutes for the presentation, and I'll do a share screen and we'll go through the presentation there and then leave the last 10 to 15 to 20 minutes for questions. A quick housekeeping item. If you have a question, you just can click on the Q&A box in the bottom of your screen. You type in your question. You can either click you want it anonymously submitted, or if you don't, it will show your name. Tim will receive those questions and then he can queue them up for the Q&A. So, if everyone can see me, hear me, see my screen, if you could just give a thumbs up or raise your hand, I'd appreciate, so we know the technology is working and everything's going smoothly there.
I see a raised hand, so I think everyone can hear us.
All right, perfect. So I'm going to go ahead and share my screen here. So what we're going to talk about today is we're going to provide a market update and talk about some investment opportunities that we see. And, we try to do these on a fairly regular basis. And so this one, give me 1 second here, just to make this a little bigger for you. All right, hopefully you can see that clearly. So first thing, like any good financial firm, we want to give you kind of the overview of what we're going to talk about and a quick disclosure. So we're going to talk about year to date, right? We just finished the first quarter, talk about different asset classes, market performance, sector performance, what's behind the 2024 market rally. That's a continuation from the 2023 rally. Then we'll go into kind of the current valuation. How much are we paying when you buy into the market today? Or even if you're holding, right? You're holding at a current market valuation. What does that look like relative to history? Then we'll talk about AI, right? Artificial intelligence is just getting geared up. It's in all the headlines in the news. And then another big thing happening about 6 months is we got an election. So, what has the market historically done in election years? What do we expect? We'll talk about that. Talk about some really interesting areas within the bond market. As Tim knows, mortgage rates are a lot higher, which has been burdensome for clients, but it is kind of nice for savers. Now that rates are higher, people can get a higher rate of fixed income, whether it's CDs or bonds. So we think there's some opportunities there. Talk about the Fed and inflation. And then probably one of the most important areas, the psychology of money and investing and how that feeds into people's decision making and the importance of understanding that when you're an investor. And then we'll finish with Q&A. Just a quick tidbit to let you all know, we try to kind of gel the themes of the presentation with some of the pictures. You can see here on the two right, that's Old Town Alexandria. All those are AI generated. So we just have an Old Town Alexandria, Northern Virginia. It generated those pictures. And so that kind of gives you a nice flavor for what is some of the potential of what AI can do in the designer artistic space. So quick disclosure, we don't want to bore you, but we do have to cover this. Any mention of past performance, right? It's never going to be a guarantee of future results. All investments involve differing degrees of risk. We are not CPAs. We are not attorneys. So this is not legal or tax advice. And we don't have, right, an agreement with any of the participants on here. So none of this should be construed as investment advice or recommendations, okay? This is for informational purposes only. And if you'd like additional information on 4J Wealth, we have a full page of our website dedicated to disclosures, and feel free to visit that at 4jwealth.com. All right, so let's dive right in. So this is the asset class performance of various asset classes going all the way back to 2009, actually through close of business yesterday. My teammate and partner, Jeff, uploaded this. So you can see here in 2024, at the far right-hand side, each of those boxes represents a different asset class within publicly traded markets. So large cap is going to be really, think of like the Dow Jones or S&P 500, those types of companies. But then that, and everyone's been talking about, how great the market's been, and it has. It's been really great from a big picture standpoint. But if you look across the board, depending on where you're invested and how diversified you are, there's a huge level of divergence, right? REITs and real estate, which have been, as you can see, going back to 2010, one of the best asset classes for many, many years, has been really struggled last year, struggled a lot in 22, and is struggling again this year. And obviously, right, that deals with commercial real estate, malls, which are struggling, right? COVID really changed the dynamic of the work environment, and that's had a huge impact on the real estate market generally, not so much residential, but commercial. Here, DM equity, developed market equity. So think Europe, Japan, right? Australia, Canada, companies publicly traded in that area. So they're still up, but not nearly what the US is up. Commodities, emerging market equity, small cap stocks, right? So companies only a $1 to $2 billion market capitalization versus 50, 100, 500 billion you see with some of the big companies. High yield, which we'll talk more about, cash, right? Money market type accounts. Fixed income's actually down year to date because rates have actually backed up. They've moved up a little bit, and fixed income kind of moves as a seesaw. When rates go up, fixed income prices go down. So that's been a headwind. If you had a diversified portfolio with differing percentages of all of these, you'd be up about 3.2% year to date. Still great for a first quarter return, right? That would annualize at about 12% if it kept up. But by no means is it what you see when you just look at the headlines of the news, which is that, you see these big tech stocks and companies like NVIDIA, which have just gone through the roof. You may be saying, well, why am I being left behind? Well, that's the main reason, is you're probably a lot more diversified and in things that aren't necessarily participating the same way. Another thing to note here, really important, is we talk a lot with our clients, not just about return, but what's called a risk-adjusted return, right? How much risk did you have to take in order to get that level of return? So you can measure, one way to measure risk is through how much volatility, right, does that asset go through in a typical year in order to get that return, right? How much the variance of the up and down, it's called standard deviation. And if you look at the left side of this chart, what you'll see here is the vol going, this is from 2009 all the way through 2023. On the left side is the return number. So the return's on the left, vol is on the right, okay? And what we're looking for is the highest possible return and the lowest possible standard deviation, right? The highest amount of return we can get for the least amount of risk. And one thing that's interesting is large cap stocks over the last 14 years have been incredible. They've averaged 14% per year, approximately, with a standard deviation of 16. So that's almost 1-for-1. That's really attractive. Some areas of the market, like small caps, are kind of inverted, right? It's still a good return, 11%, but you had to take a lot of risk to get it, right? You had to take twice as much risk per unit of return than you did for large cap stocks. An area we're going to talk about today that we think is appealing is not just high yield generally, but high quality high yield. That's done 8.6% per year return and has had a standard deviation 11.5, right? So pretty good, right? Almost 1-for-1, not quite, but quite good. A diversified portfolio, likewise, similarly, 8% return per year, right? Historically, right? Looking backwards, with taking about 11.5% standard deviation or risk. So again, pretty good. But if you just pick anyone, the commodities have had a negative return over 14 years, and you've had to take massive risks to get a negative return. Not very appealing. Doesn't mean they can't be good going forward, but that kind of makes sense, right? Because 2009 through basically until 2022, right? Inflation was barely, couldn't even get to 2%. You had the fracking revolution in energy, which kept energy prices very low. So you can have these weird things that happen in the market where for a decade or more, returns in some asset classes can be really subpar or conversely really, really good. And a lot of times these things can mean revert. So I'm going to move forward here. This looks a little bit more granularly just year to date. So through April 3rd of 2024, various asset classes and what the return is at year to date. And then the S&P 500, what that's done. So in the first quarter, that's up about 9%. Okay. So if you're just looking at the S&P, you say, oh my God, that's incredible. Like 9% is really good. But parts of the market, okay, some asset classes, some sectors, I should say, these are sectors, not asset classes, have done even better. Communication services up 17%. Again, big picture, that sounds great, but you have to look a little bit in the details because 50% of that sector, okay, is dominated by Meta or Facebook and Alphabet or Google, right? And those have had incredible starts to the year. And so that's driving. Whereas if you look at a Sprint or a Verizon, it's not going to look, AT&T, it's not going to look near that good, even though they're in that sector as well. And then the other side of the spectrum, real estate, we talked about it struggling in 2023. It continues to struggle. And that's just the overhang from office vacancies, the commercial real estate woes and struggles you hear about, the refinancing wall those companies are going to face. It doesn't mean there's not pockets within it that are doing well. There are, think data center companies like a Prologis, for example, but overall that's struggling. We'll come back to this later, but interestingly, the sectors that are doing really well historically have done well in election years, and the ones that are struggling are kind of following history's pattern and struggling year to date. That doesn't mean over the next 3 years, though, that trend will hold. A lot of times you want to be looking at sectors that are struggling today because you have a little bit of a longer time horizon. Having that longer time horizon allows you to lean against the grain and get better returns, sometimes for less risk. Okay, and we'll talk more about that as well. Again, if you have any questions as we go through, please just pop them in the Q&A. It'll go to Tim, and we'll make sure we cover those. Bottom line, there's a lot of charts on here, but what this is saying is that investors, Wall Street, the sentiment of the market, this is a huge change in trend from 2022 to 2023. And a big reason the market's up is just investor sentiment. The narrative around the market has changed completely. It is bullish. Okay. And you can see that by looking at, this is just a survey gauge of the number of bulls, number of bears, and then the spread between the two. I mean, in 2022, you can see here, people were very bearish, right? I mean, there were more bears than bulls. Now, bulls are matching kind of the last peak we hit in 2021 versus bears are at an all-time low. So the spread is back at a highs. Well, this doesn't mean this can't go on for another 3, 6, 9 months. But to us as professional investors and fiduciaries, we want to actually try to be a little bit more cautious during these time frames. because investor sentiment is fickle and it tends to mean revert. And right now it's very optimistic, but that doesn't mean it's going to be optimistic, a year from now. And generally when it's optimistic, market prices are higher. People have bid securities up more. And so just keep in mind that with more of a contrarian mindset, we want to generally be a little bit more cautious, right? A little bit more fearful when the market in general is getting greedier. And we are seeing signs that here, we're seeing signs of it just based on the work that we do with clients. A lot of you, if you follow financial news, have heard of the Magnificent Seven, right? It's the big tech US companies, Meta, Amazon, Apple, Alphabet, NVIDIA, Microsoft, and Tesla. If you were to take an equal weight portfolio of those 7 companies and start it back right before the pandemic, that would be this Magnificent Seven kind of dark blue black chart here that you see, up 315% since that time frame. Whereas still done very well, right? The NASDAQ, which is a little bit more tech heavy, and the S&P 500 since that time frame are up respectively 81%, and the S&P is up 61%. But the point is, as we're going to see here, a huge portion of the return of the overall market has been driven by these 7 companies, because not only have they done incredibly well in terms of their performance, right? But they are massive constituents within the overall index. The index, the S&P, the NASDAQ, they're market cap weighted indices, meaning the bigger the company, the bigger the contribution of return, positive or negative, that's going to contribute to that index performance. So these companies comprise close to 20-25%, even though only 7 companies, of the entire S&P 500 weight. Okay, so their performance up or down, and that's part of the reason 2022 market struggled so much is, people forget this. All they want to own now is the Magnificent Seven. But in 2022, those companies declined 47% in aggregate, right? And Jeff made the point to me, my partner, earlier today, is if you take out NVIDIA year to date, you take out that one stock, the other Magnificent Six are basically roughly flat year to date. Or no, excuse me, not flat, but only up 6%. In other words, up less than the overall market. So you go a little bit under the hood and you can start to see how some of these numbers and overall performance can get distorted. Just kind of carrying through that point. If you think about the market over the long term, the market is driven by macroeconomic forces, but the key ingredient of what drives stock prices over time, stock market performance over time, it is earnings and earnings growth, the quality of earnings growth and the level of that growth. And right now in 2024, Wall Street is anticipating, they see the first half of the year, all of that earnings growth is coming from the Magnificent Seven. And then the back half of the year, it's kind of broadening out to the other, what are now being called the other 493 or the S&P 493, right? This is the consensus. It doesn't mean that it's going to happen. It's just saying that the narrative is very, very strong that the Magnificent Seven are going to carry us through the next quarter and into the third quarter. And then it's going to continue, but it's going to broaden out to the rest of the S&P 500. This is a little bit small. We apologize for that, but it gets into the valuations. And, one of the big misconceptions, if you're just looking at the, PE multiple, which is the price to earnings, how much am I paying in price for $1 worth of earnings? Well, in the overall S&P 500 right now, you're paying almost 21 times next year's earnings, right? Paying $21 for $1 of earnings for next year, okay? Which is definitely above the average. But again, when we look a little bit below the hood, it's a little bit of a different story. Tech, Apple, right? Microsoft, Meta, Alphabet, Broadcom, NVIDIA, all these tech companies, Salesforce, they are trading, right? They're not an insignificant part of the S&P 500, but they're trading about 29 times next year earnings, which, right? You look here, the average of those companies over the last 20 plus years, 30 years has been about 22 times. And the reason they traded slightly elevated levels is they're, more profitable companies, right? Better business models, more competitive advantages, something we really didn't see pre-2000 as much. So they traded at elevated multiples for good reason, but right now they're trading, basically one full standard deviation above that level. And the only other time it kind of went above that level and stayed above that level was in the late 90s before the dot-com crash. So not at all saying that's going to happen. I don't think we're anywhere near these levels, but again, we're elevated, right? But if you look at the rest of the market, if you exclude those tech and look at the rest of the market, it's fairly reasonably valued, the market, trading about 17, 18 times earnings. The average is about 17. So certainly not at depressed levels, but we're not back in kind of that COVID Goldilocks era where rates were at zero and people thought no one would ever go back to work. And when it traded well above 20 times. So I think this is some helpful perspective. Parts of the market that frankly are very tied to AI and tech more broadly are trading at elevated levels for some good reason, but there's going to be winners and losers in that area. But the broader market that has industrials, financials, healthcare, utilities, trading much more reasonably. So this again is zooming back out. This is from JP Morgan. Again, you don't need to focus too much on the charts. I'm going to explain them, but this is looking at a 30-year average of that PE multiple, which is trades historically at about 17 times. Right now, we're at about almost 21 times. Okay, so well above the norm, above one standard deviation. So you want to be cautious in this environment. Whereas in 2022, just a comparison, right? It got well below. It got 15, almost 14 times over. We're in a recession. Everyone thought we were going into one, but broadly, it did get much less expensive. But the thing to note is, while this is elevated and it is on the pricier side, you can't take that in a vacuum. One, we already looked at. Most of the market is actually lower, but there's a few very large companies that are pulling this PE multiple up, pulling the overall average of the market up. But secondly, S&P 500 profit margins, right? Their earnings relative to their sales, they're a lot more efficient, right? A lot more profitable than they were 20 plus years ago. Right, you can see here's the profit margin of the S&P 500 over time, and you can see it's been volatile, especially during recessions. That's this gray shade area. 08 was very rough, but they've moved and become more profitable over time as more and more companies have embraced technology, which has increased their productivity, their efficiency, leading to higher profit margins. Okay. All right, there's no question, other than the drastic change in market sentiment that occurred from kind of the end of 22 to 23 and now into 24. Sentiment change is a huge reason why the market has had its resurgence. But the other one is artificial intelligence, AI, right? I mean, we're now, ChatGPT was released at the end of 22. In 2023, more and more companies started beta testing. Consumers starting to get more comfortable using ChatGPT, seeing its implications. And the poster child for this is NVIDIA, right? They have a stranglehold on the AI market through their manufacturing of GPUs, which has led to that particular stock doing incredible things, right? So when we're talking about AI, we really need to look at it as an ecosystem. And we have some examples here of companies in that ecosystem. Don't go and just jump and say, I'm going to go buy all these companies, right? That's not what we're saying. And I don't think that should be kind of looked at in a silo as an investment strategy. It could be part of one, but this is really just to educate you on how the AI ecosystem works. Kind of at the base foundational level, it's powered by chips, right? And most of the chips are GPU chips, and those are manufactured predominantly by NVIDIA, followed by AMD, and then there's some others. And then Arista is a company that does the plumbing for the data centers and for companies who are building their own, who want to build their own servers. Okay, up from there, you get the computational, right? The computational power that's required to actually run the systems on the chip. So that's companies like AWS, Microsoft Azure, Google Cloud, NVIDIA actually has software that runs compute, giving them an additional competitive advantage. But most of the costs, okay, of AI come from the compute power. And that's done in the public cloud and in data centers. They are the majority of the ones that actually do this compute power. Above that is the data processing, the storage, the management of the AI, right? So again, you can see there's some common themes here. AWS, right? They're in multiple levels of the stack. Google, multiple levels. Microsoft, multiple levels. You see some other companies in here, Snowflake, Databricks. And then from there, you get to where the consumers are starting to actually experience this, which is in some of the models that are being created, right? So OpenAI is probably the biggest. Microsoft owns roughly half of OpenAI. So, right, even when they aren't the company directly doing it, they're benefiting from it indirectly. And then on top of that, you get the application layer, right? So that's where, companies are rolling out specific applications for their customers using these models. And that's really where this thing could go everywhere, right? It can get into every part of the economy to increase productivity. Frankly, it's going to disrupt the economy in massive ways. It's going to replace jobs. It's going, especially, 2025, we think that if you look and you look at these surveys of Fortune 1000 companies, they have, a lot of them are beta testing this. But in 2026, that's when it's going to start getting rolled out and you're going to start seeing really big changes occur. I'm not going to spend too much time here, but again, we talked about the stranglehold NVIDIA has over the data center GPUs, the models, OpenAI, Microsoft, AWS, Google are dominant, and then the services, Accenture through their consulting, helping companies, frankly, develop AI, implement AI, build AI applications. Some of the other software companies like Adobe, ServiceNow, Salesforce, right? They all are a kind of services layer of the Gen AI market. AI mentions on earnings calls has gone up parabolically, right? I mean, it was basically not at all mentioned in the mid-teens, and now it's, constantly being cited. So, right, companies are testing this, they're integrating it, they're aware of it, and they're using it. And we're going to show you that. What is the computational power? What is that acceleration going to look like, right? This is trillions of operations per second. This is kind of hard for the human mind to understand. And obviously 10 to the ninth it's a huge number. But what you're seeing here is the computational power of a CPU, and this is logarithmic, but basically it was incredibly fast. But over the next 10 years, GPUs, computing power and performance is basically going to double every year. So it'll be 1,000x in 10 years what it is today. So the productivity gains to every pretty much sector of the economy is going to change dramatically over that time frame. Probably in a way that's kind of incomprehensible today for most of us to understand, including us. But we're just trying to give you a sense. I mean, Jeff and I were talking about what does that mean? One example, I want to make sure we get everything in on time, is you think about like video games or the artificial creative films using graphics versus actual people. It's going to get to the point where you can't distinguish between an AI film and an actual film that's filmed with a camera with real people. Maybe not for a while, but that's the direction it's heading, and this is what's driving that, is that you get greater and greater computational power. The lights that, how light and shadows are created, it can happen instantaneously, and AI is kind of running the show there. A little scary too. There's definitely some parts of this that are kind of freaky. Will AI usher in a productivity boom? We think so. Particularly if you're looking at over 3 to 5 years, it's going to really start to happen. Customer service, operations jobs are really, the potential time reduction, right? 42%. Maybe a little bit less in areas that are more service oriented. Even legal is going to have disruption. Every sector is going to have disruption. And, we're going to talk about this, but we're going to show you this rather, but there is right now a AI powered option, AI only powered option oopsie. An AI only powered option of a Wendy's in Ohio. And we're going to show you kind of what that looks like. But our guess is it's a pilot that's going to be basically the norm for fast food companies, you know, whether it's 3 years, 5 years, you're not going to give your order to a human because of how efficient and accurate, frankly, the AI is. Now, one unspoken or not as talked about issue with AI is there's incredible power demands to run these algorithms and these models. So, right, this is a projection of the power demand in gigawatts going back to 2019. And you can see in 2023, it inflected massively up and to the right. Right. So the amount of power, the amount of electricity that's going to be required to run these things is going to be astronomical. You know, the energy need we're going to have is going to be, I think, beyond most people's expectations, beyond some people's comprehension, and we're going to need to get very creative. But you can just see, I mean, that's 2023. In 2025, it could inflect up like this again, right? We just don't know. But Warren Buffett talked about it in his most recent shareholder letter that we read about when kind of the dust settles and there's more clarity on AI, the need for energy and the amount of energy is going to be staggering. And we would concur, and certainly a lot of the utility research organizations, think tanks are saying the same thing. So here's your first taste of AI in action. Hopefully you can hear this. This is a gentleman going through the Wendy's AI drive-through with the AI option.
What would you like?
Hi, can I get one bacon double stack biggie bag?
What sauce for the biggie bag nuggets?
Can I get barbecue sauce?
Which straight for bacon double stack biggie bag?
A Coke, please.
Which straight for bacon double stack biggie bag?
A Coca-Cola.
Got it. Anything else?
Also, can I get a beige plastic single?
Got it. Anything else?
On that beige plastic single, can I get no cheese and extra pickles?
Would you like anything else?
Can I get extra cheese, extra pickles on the beige single?
Anything else?
Can I get no cheese on the beige single?
So, right, I mean, the idea there, and we're going to watch another one here, but and we won't watch this whole one because it's too scary. But the idea is that he didn't try to confuse it, but he changed his order, and you know, it had one hiccup, I think, but it got it right. And as all you know who've gone through fast food drive-throughs, rarely is it right. So it got it accurate and in less time. Now, this is one to show you that these Gen AI models are actually reasoning. They're not just taking information and spitting it out. They're learning from the information that they get and getting better iteratively. So this is from March of this year.
Figure one, what do you see right now? A red apple on a plate in the center of the table, drawing rack with cups and a plate. You standing nearby with your hand on the table. Great, can I have something to eat? Sure thing. Great. Can you explain why you did what you just did while you pick up this trash? On it. So I gave you the apple. It's the only edible item I you at the table. Great. So based on the scene right now, where do you think the dishes in front of you go next? The dishes on the table, like that plate and cup, are likely to go into the drying rack next. Great. Can you put them there? All right, so how do you think you did? I think I did pretty well. The apple found its new owner, the trash is gone, and the tableware is right where it belongs. I agree. Thanks, Figure One.
So again, we're not going to go through the whole thing, but it gives you a sense, right? It sounds like a person, it doesn't look like a person, sounds like a person, it can move its hands, it can contort things. I mean, it's very impressive. And I had a friend who went to Vegas to the Sphere with his kid, and they have a robot similar to this who actually interacts with the audience. And it was smart enough he was just talking to the 5-year-old kid, and he said, you know, whatever his name was, said, "Is that your father standing next to you?" And he said, "Yes." He said, "Well, tell him he's raising a very intelligent child." You know, we're already at the point where it's like, geez, this thing feels like it could be a human. So now let's take a moment away from AI and pivot to the election that's coming. A lot of attention is on the election and politics and what this election is going to have as an impact. And there's a lot of fear, I remember, in 2016, based on who was going to win, and if Trump won, that the market would crash and we'd go into free fall, which obviously didn't happen. But, you know, this time, you know, we're being told is different. But basically, going back to FDR, you know, World War II, pre-World War II timeframe, this just shows you Democratic presidencies, Republican presidencies, and what the market's done. And it's hard to discern, right? Basically, sometimes Republican presidencies do better, sometimes Democratic presidencies do better, but there's no rhyme or reason as to which one's going to do better, right? Clinton, Democrat, market did incredibly well. During Bush, market really struggled. Obama, well. Trump, well. Biden was really good, then not so good in 22, and now it's coming back. So it's a mixed bag. Again, we're just looking at the facts historically, but the S&P total return in election and non-election years going back to 1933, you can see in non-election years, right, it's done the best. But even in election years, the blue, it's still quite positive. The average has been double digits. The worst performing years historically have been midterm election years. But I would just say, be really cautious making investment decisions over a presidential election, because what really drives, like we talked about before, market performance is corporate earnings, right? It's more macroeconomic things like inflation and the job market and housing and interest rates. Yes, of course, policy decisions and who the president is can have an impact and move things on the margin. But to make wholesale investment decisions, we think is not prudent based on who they think is going to be president or not. This is kind of interesting. This is breaking down the sector performance in election years, going back to 1976. And this dotted line is the S&P 500, sectors that underperform, sectors that outperform. And you can see here, energy in election years has been, historically speaking, probabilistically, and that's continued. It wasn't true the first couple months of the year, but the last month, energy's taken off. It's up about 15% year to date. And then some of the worst performing sectors relative to the S&P, they could still be positive. Things like healthcare, utilities, materials, et cetera. Again, be very cautious. This is just informational purposes. It does not mean to go out there and buy based on this information. But people want to know this. They want to understand. But a lot of times I'd say, again, if you're looking out 3 to 5 years, some of the best value that we see in the market today is look, let me caveat that. Technology, big picture, we think is going to continue to take market share over the long term, the next 3, 5, 7, 10 years. Okay. It's not going to be perfect linear, but we think it will continue to take share for all the reasons we talked about today. But there are also compelling kind of risk reward opportunities, we feel like, in sectors like utilities, healthcare, even still kind of, you could argue, energy. So the point is, just because the sector tends to underperform the market in election years doesn't mean 3 years out it couldn't be one of the better one of the better sectors, or have some of the bigger winners in it. So let's pivot quickly here to the bond market before we wrap up and take questions. So the bond market, the two areas that we think are interesting right now and worth looking at, have good risk reward characteristics, kind of highlighted before, is high quality, high yield, and bank loans. Bank loans, basically their coupon resets every quarter based on where rates are. And so you know, if rates go up, it actually helps bank loans. And they're currently yielding about, 8 to 9%. High quality, high yields yielding about 6.5 to 7.5%. So the way we look at this is these companies are much more well capitalized. The economy in general is less cyclical than it's been in the past. And if we think about where the market over the next 3 years goes from here, we'd be thrilled with a 8 to 10% return from here. Whereas this, we can take a lot less risk, or somewhat less risk, and still get about the same return. So we think if you're trying to get money off the sidelines that's sitting in cash, or even want to take some profits in stocks, I think that we think with the right managers, okay, who really do very rigorous security underwriting on a case by case basis, we think this is a very attractive area to be in the next 2, 3, 4 years. And you can see here, just highlighting high yield and bank loans, right? They're currently yielding overall 8% and 10.5%. Their historical average has been 6.2 and 6.1. So again, you're getting equity or stock-like returns with lower average volatility if you look historically. Interest rates and inflation, everyone wants to be a prognosticator for where those things are going, even though no one really knows. The one consensus is that the Fed is done hiking, right? The Fed's basically said it's done hiking. It's just a matter of how long it holds rates before it starts cutting them. S&P returns, the red is kind of how the market's done since the last hike. And these are historical returns in different time periods after the Fed's last hike. So, right, you had the worst case was 99, 2000. Last hike occurred, market actually was negative because the dot-com bubble. 2004, 2006, was up and then kind of flat 2 years later. And then you have, if the Goldilocks scenario plays out and inflation comes down and they can cut rates without spurring inflation again, you could see one of these types of scenarios play out, but it's too early to tell in our opinion. And then fixed income, 10-year US 10-year return, 10-year treasury returns, right? Again, the risk reward here is attractive in fixed income in our opinion. It's not saying ignore equities, but look, you get a narrower range of outcomes, historically, right? 83, 84 was the outlier to the upside, but in 2 years up about 5 to 10%, 15% per year. So far we've been flat, but that doesn't mean that's gonna continue. So it's kind of odd, right? Like rates haven't dropped, but stocks have taken off. So there's a disconnect there between what's happening. The lower energy prices that were kind of helping inflation come down, that's probably behind us. You've seen energy recently go up in price. What's happening in the Red Sea and in the Middle East, that's not helping. That's making more cargo ships have to go around the Cape of Africa, increasing costs, right? Transport costs, which feeds into all prices. And the rate of disinflation, right, it's definitely come down, but it's moderating. And the one area you hear about sticky inflation, how do we get from 3% CPI to 2% CPI, which the Fed has said is its goal? It's services is the problem, right? That's this yellow orange bar you're seeing, and it's kind of flatlined. Right, so healthcare services, travel, hospitality. I mean, you probably know as well as me, if you want to take a trip, prices aren't going down. Other things are moderating. Energy actually negative. Goods, really was terrible during COVID because everyone bought things, wasn't going anywhere, and now it's not contributing to inflation. But services, that's where the rubber meets the road. Can that come down? AI is going to help. But it's probably not going to help in the next 12 to 18 months. It's going to be more like 24 months and on. Again, you can see 12-month trend on inflation, peaked around 6% for core CPI, and is now sitting at about 4%. So again, that's core CPI. So that factors in, that excludes some of the volatile parts of CPI like food and energy. Okay. Psychology of money, psychology of investing. This really makes investing hard. And when you look at the S&P 500 historically, depending on the time frame, but over long time frames, it's averaged about 8 to 10%. And in theory, an investor return should match that, right? 8.2%. The problem is it doesn't. Investor returns are systematically lower than the broader market by a large margin. And it's like, why is this happening? We're calling it's called the behavior gap. And the reason it happens is because we are human beings, and as human beings, we have a rational part of our brain, and we have the part of our brain that's that has been around for many, many millions of years, which is much more emotional. And under periods of stress, which happens when you're losing money or losing money in the market, that rational part of the brain shuts off, and our decision making is driven by those emotions. And this affects retail investors and professional investors. So, right, the typical cycle is, people get optimistic, then they get excited as prices go up, then there's the thrill. It's, oh my God, I'm going to get rich. I am rich. I'm going to keep going. And then this is actually the point of maximum financial risk, where it's, that's in the .com or during the COVID bubble, where people were just making money so easily. You can day trade from home, you can quit your job, all really bad signs for the future returns. And then on the way down, you get anxious. It's not real. It'll come back. Then there's fear. Then there's desperation. Then there's panic. And then there's capitulation, just getting out. How could I have done this? And then depression. And then the cycle repeats. This will not go away. This AI will not get rid of this. This will be around hundreds of years from now. And this is what makes the investing world so difficult and so fascinating at the same time. As human beings, there's lots of biases we have, but I think if I were to boil it down to the one that impacts poor decision-making with investing, it's loss aversion, meaning we are much more susceptible to feeling the pain of a loss than we are to feeling the pleasure of an equal amount of gain. We are much more susceptible to feeling the loss, of losing money. It's if we feel it more intensely than we feel the good part of an equal amount of gain. And an analogy is if you imagine a bucket filled with colorful balls, and all those balls represent your overall happiness. The higher the number of balls, the happier you feel. But adding balls to the bucket feels good, but the more balls you have, right? You got 10 balls, the 11th ball feels pretty good. You have 100 balls, the 101st ball doesn't feel as good, right? You have a diminished sensitivity, right, to adapt to that positive experience. So you require greater increases in good things to feel that same level of pleasure. But losing, right, removing balls from the bucket feels significantly worse than adding an equal number of balls. Felt good. So it amplifies that impact of loss. And what do you do when you're feeling that amplification of loss, right? We tend to get afraid. Our friends are selling. Are we ever going to get our money back? What if it goes down further? All these things start to, and it's just day after day, night after night. And that's what happens in a bear market. And then people end up selling. And that's that behavior gap. So a big part of our job and financial advisors' job in general is to make sure they really understand and help the clients understand what is the rate of return that we really need to get to reach your financial goals. What is your risk tolerance, right? What can you stick with in good times and in bad? And then that's the most important thing, is having that investment plan that you can stick with over a market cycle. It doesn't matter if you can stick with it in a good part of the cycle. Everyone can do that. The hard part is sticking with it when the cycle turns, right? When we go into a recession or a slowdown, that's not a recession. And all you're hearing in the news is about how everything's going to get worse. Everybody, every CEO, every Wall Street person, every analyst, every portfolio manager in 2022 was saying there's going to be a recession. Didn't happen, at least not yet. So be cautious of reacting in the short term, even if you hear some of the smartest people saying things are going to get worse. All right, the market, again, that's that leaning against the grain, trying to be confidently contrarian goes a long way. All right, I know I'm in a minute over here. Let's pivot to Q&A. Tim, if I can bring you back on, or I can read out the Q&A if you want.
Yeah, first off, thank you so much. I got 3 pages of notes here, so this is good. Thank you. Yeah,
Sure.
we do have some questions here. So I don't know if you can see them or not. You and Jeff in the room. The
Yeah,
first
Jeff's here
one.
too.
Okay, hey Jeff. So the first one we got there is if I read the slides correctly, looks like the Magnificent Seven stocks are overvalued and their prices should start coming down in Q4.
Yeah. So certainly they're valued more expensively than the market, and on the high end of what they've been valued relative to their history. It does not mean that they're necessarily going to go down at a particular time like the fourth quarter because things are going to slow down. It's impossible, in our opinion, to time the market accurately with any, right? You probably know that from real estate. Right. It's not, but it's more saying a lot of optimism has been priced into those securities, right? That Magnificent Seven. And there's a chance that those companies do continue to win. But I think what we would say is that you want to think of everything kind of as a grayscale, right? A distribution of outcomes. The market is pricing in that those companies have to deliver really good results to continue to do what they've been doing or to hold where they are. But if they disappoint, the downside, right, will be skewed a lot more, right? So they disappoint, or some of them don't win in the AI revolution or don't win as much as the market expects, they could actually go down a lot more. So there's, you look at it as like it's probably skewed a little bit to the negative in terms of the future returns. Would you add anything?
No, that's perfect, yeah.
No.
It's a really good question. I'd love to give you a simple yes or no answer.
Okay, we got one over here. How do you advise your clients who are retiring during a low cycle of the financial market and don't have much cash savings?
Okay, so that's a really good question. When we work with clients, we go through a comprehensive financial plan. So we're looking at everything from their assets, their liabilities, their income, right? If they're going to get Social Security, when is it going to turn on? Pensions, what are their expenses? How much are fixed? How much are variable? And so if we're in a down part of the market, and the plan still works, right? So let's say we run through the plan, even at these depressed levels, the plan works, then frankly, we might be saying, look, you're still okay. Like in fact, retiring at a market low is ideal because then you get really positive returns coming out of that down cycle, which is ideal. There's probably more risk to retiring in a market bubble in a peak. There's a lot more risk than retiring when it's kind of in the doldrums. So it's contrarian or paradoxical to what you might think. I'm not sure that answers that question. And if that individual wants to clarify, or anyone can email us directly at info@4jwealth if they have more specific questions or want to talk more specifically. But it all comes down to the plan and running those cash flow analyses and modeling it out and just saying, look, we're not looking at the next year. Your retirement, we're looking over the next 10, 20, 30 years. So.
Okay, so your AI, it's pretty scary what we're seeing with AI, right? And in every different sector. So one of the questions we had here was, how are you using AI in wealth management?
So we have to be cautious of using AI in wealth management as it pertains to client data or putting in client information. But we look to stay informed and to have a ground level understanding of what's happening. We, of course, you can use Bing has a co-pilot for free that you can use, which is powered by ChatGPT. We have a ChatGPT premium subscription. So we'll oftentimes, right, you could, Jeff has looked at things like historically, after the market's up 20%, give me, the upside downside of what the market's done over the next 1 year, 2 years, or conversely, the market's down 20%. And then of course look at the sources it references and then go check those sources. But we absolutely use it as a starting point to gather information or to pose questions. Just like we got these old town Adobe pronounced AI. We're using it in ways, seeing how it works, trying to introduce it to clients so that they can understand. Look, this is not hypothetical. This is not like someone started a
Oh, are you there? Looks like Josh's screen froze. Anyone else give me a thumbs up? Can they still hear me? Anyone else still hear me? Oh no. Okay. I think we've lost everyone, but thank you so much for joining. It must have been a glitch here at the end, but I hope everyone got a lot out of this session. So thank you again, Jeff and Josh, for your presentation. It was absolutely amazing to listen to all these things and understand a little bit more about that.
Sorry.
Sure.
There you go. You're back.
All right. Sorry about that.
That's
I was
okay.
just saying, we have fed in kind of SEC filings just to kind of
Oh, looks like we have Wi-Fi problems here right at the end, but that's okay. What we'll do is we will take down these questions and maybe I can get a Q&A from Josh and Jeff as a recap to this. So thank you everyone for joining this webinar.